Now we've got it all in this next interview: recession, trade wars, Brexit, climate change. What will the future bring? Everyone's asking the questions, but Investec's Global Investment Strategy Group meets quarterly to map out the next 18 months and may give us some of these answers. Now, one of those on this group is Annalisa Pierce, the Chief Investment Officer at Investec Bank Switzerland. She joins us now to talk about the future. So, Annalisa, on the face of it, it's very, very bad times for everybody. Everyone's complaining the world over. As I say, what more do we actually need to be in trouble? But your side of it, what are you seeing?
So, we have a slightly different perspective living in Europe, and Europe has had a sharp slowdown because of we're particularly exposed to China and emerging markets. So the Chinese slowdown has affected Europe. We're starting to see the green shoots of Europe stabilizing. One of the other reasons Europe did so badly last year and the year before is because the euro was very strong in 2017. So 2018, Europe paid for it in growth. I think it's probably going to be a similar situation for America. You have had very strong dollar, and what you do then is you export growth to the rest of the world. But the advantage is you're importing deflation from China back into America.
And you said the inflation wasn't as bad as you thought it was going to be in the States, and that's helped your...
Two reasons. So at the moment, the inflation numbers are still quite high. But I think it's the 9th or the 11th year that inflation is undershooting what the Fed has expected inflation to be. And the strong dollar, the fact that the oil price came down, is all going to mean that the second half of this year inflation is going to be a lot lower than most people expect.
And overall in the bond market, in your particular section, how is it looking? What are the prospects?
We've had we started last year off and people were really excited about being in the equity market, and then the bonds and cash ended up being the best performer asset class. And it's always like that when you have a bit of uncertainty, people run into G10 debt. US Treasuries, because the Fed had hiked rates so high, you had a strong dollar, it was an easy option. I can earn 2.5% in cash. Strong dollar. People that were a bit scared of the market just went into those areas. The same thing we saw with the Bund. The Bund was paying 80 basis points last year, and it's now at 0. So the bond market is actually having a little mini rally.
So how does all of this, this mini rally you mentioned, how does it all translate back to the economy here?
So what that has done, you've had quite a risk-off phase. We've seen that in December. When you have a risk-off phase, the bond markets rally. What is holding South Africa at the moment back, because your interest rates are so high, it's actually a no-brainer if you're an offshore investor to buy South African interest rates and the possibility that the currency will strengthen. However, the election is keeping people on the sidelines. People that I see, investors around me, they do not like to invest in a country in an election year. So they will wait for the elections to be out of the way, and then I think quite a lot of investors will buy South African bonds.
So you think investors will be on the whole for the rest of 2019, basically?
No, I think once the election result is out, you will see them back in the market, because there is a search for yield. There's a search for investment returns, and we are a little bit in a risk-on phase. The one thing that could dampen it a little bit is the summer months in Europe and America, the markets actually go into a bit of a slumber, because those are the big holidays. But for the end of the year, I'm quite optimistic on
Give me an
assets.
idea of returns, say, comparing to Europe. I know it's quite difficult, but comparing to South Africa here to Europe in terms of investment returns, in percentages.
What is interesting is if you look at Switzerland, where we have absolutely no inflation and a very strong... We have in Switzerland the exact opposite to what you have in South Africa. We live with a strong currency. Strong currency is very bad for Switzerland because we're an export market. South Africa, emerging market exports also are very important. So having a tendency to a weak currency is very good for the economy. A tendency to a strong currency is bad for our economy because it kills our exports. And that's why they cut the interest rates to negative. So if you put cash in the bank, you pay the bank 75 basis points to hold your cash. And the returns in the equity market has been sideways for the last 20 years. So end up having to trade the market. So you will buy, for example, a blue chip stock in Switzerland is Nestle, or the healthcare stocks. You will buy them if they're cheap, and then you have a certain band where people take profit. They're struggling to buy government debt, but they will buy some corporate bonds, but they have to invest it offshore. But what we've seen, funnily enough, Swiss people only invest 10% of their wealth and portfolios. That's pension funds, the man in the street offshore, because the Swiss National Bank dropped the peg 2 years ago and the currency weakened, strengthened 15% in one day. That gave the man in the street such a shock that they now don't trust the currency to stay weak. So it's really the opposite of South Africa.
So if you're paying in Switzerland, paying the bank to look after your money, basically, surely there should be a rush of Swiss investors to this neck of the woods where maybe you can get 20% plus of return.
They will do it with 5 to 10% of their wealth, but not more than that. Because if you live in a strong currency country, you can't take so much currency. You can take currency risk on a small part of your portfolio.
So what do you think is going to be the things to look out for in the bond world in the coming year?
I think the inflation numbers is going to help us. If you have more of a recessionary risk, but that will be coming from the general risk, the geopolitical risk, the trade wars, a little bit of populism. Populism that we've seen is rising in the whole world. You know, it's back to the levels that we've seen since 1930. But the populism, funny enough, in Europe is not the same as what we're seeing in the Anglo-Saxon world that led to Brexit and Donald Trump. So everybody speaks about France. But a traditional French action when people are in the streets and rioting used to be 4 million people in the street. The gilets jaunes that we have at the moment, the yellow jackets, I think March last year they managed to muster about 300,000. And that's quite weak in French. You know, revolution is in the French blood. So every young Frenchman has to go and have some protest, and when they grow up and become taxpayers, they become really calm. So what we're seeing at the moment, the gilets jaunes, in the context of populism, people think it's very populist, but ultimately Macron has managed to pass 75% of the things that he promised in the election, despite the protests.
And a lot of leaders around the world wouldn't mind that kind of a percentage success rate, exactly. But this stability that you're talking about in Europe, I mean, even in the States as well, there's this tremendous one nation populism going. What do you think that's going to mean long-term economically, you think?
I think the world is changing. So we're sitting, if you look at mega trends in the world, you sit with aging populations in the developed world. We've seen the wave coming through Japan. So it's lower growth rates, lower inflation, but it's something we're not used to, but it creates stability in the long run. I think the only volatility that we'll have will come from a geopolitical point of view between the US and China. With Chinese GDP now making up 17% of world GDP, you're suddenly going to have a multipolar world. And multipolarity brings volatility, which ultimately is good for bonds because that's your one insurance asset against volatility. But in Europe and Japan with aging populations, I think we're going to have we'll have to come up with a new, capitalism worked until now. But capitalism, I'm not so sure is going to work in the future because capitalism is built on consumerism. We now have aging population in Europe, and behind it you have the millennials that do not want to own a car, a fridge, a house, and they don't want to take on debt.
But surely companies like Switzerland, they're on the forefront of this because, I mean, I've been there reporting and, you know, everything's sorted out and everything's paid for, everything's looked after, almost like a socialist state.
We are social democracy.
Yeah.
And it's not a bad thing, but what you'll have to do is you'll have to try and capture tax for the ultra-high net worth people, so the 0.01 that are not paying tax, to actually look after most of the people that cannot get jobs, because we have growth without jobs. And I think that's what we will see in the next US election. A lot of people will start saying we expect 70% tax, which sounds frightening, but the tax rates that corporates and American individuals pay are quite low by historical standards. And if you look at Amazon, for example, Amazon was built on the infrastructure that was put in place by the middle class taxpayer. They've been using the post office. They use roads to move their products. So somehow they have to find a way to reinvest that back into the economy.
Anyway, but this has been a fascinating interview, I must say, wide-ranging from Brexit to Amazon. So, but I'm afraid that's all we've got time for. So that was Annalisa Piers, the Chief Investment Officer at Investec Bank.